Investments are for the rich. You're too young to invest. Investment is gambling. We've all gone through these questions once in a while in our life. Questions like these have been circulating in our economy for a while now. And it's high time we start addressing these questions rather than running away from it. Is investment bad? I mean, what do we have in terms of options when we talk about investments in our country? FDs, RDs, gold, bank deposits. Is it this limited? Don't we have any other options to consider? Before talking about the other options that we can consider, let's talk about why I think these are not enough. Bank deposits, RDs, FDs, everything is fine, okay. But why these are not enough is because of a concept called inflation. If a bank is providing you a return of 3 to 4% and inflation percentage is much higher than that, then in the long run, you are actually losing the value of your money. You're losing the purchasing power of your money because ultimately the percentage of inflation is higher than the interest that you're getting on your deposits. So obviously, you don't want to lose the value of your money in the long run when you're investing it with the purpose of actually increasing your purchasing power and your wealth. What options do we have then? Before talking about those options, let's talk about the questions that we started our video with. Investment is for the rich. I don't think so. You can definitely become rich by investing though. Because you can start investing by as low as rupees 100, and by investing rupees 500 a month, you can actually have ample of opportunities to invest into. So it's definitely for everybody. Second thing, you're too young to invest. How can somebody be young to invest? I mean, Warren Buffett started investing when he was just 12 years old, and he's one of the most successful people in the world, one of the wealthiest people in the world, and he has made his fortune through investments, which means that there's no age limit for investment. You can start investing from your pocket money. Depends on how you want to look at things. Third, investment is gambling. It's clearly not. Just one thing, just one example. If you don't study for even a minute and you know your exam is tomorrow, you just start, just go and give your exam without studying a bit. You know you're going to fail, right? Similarly with investments. I mean, if you straight away go to stock market and you start investing in any stocks of which you have no knowledge at all, you're guaranteed to fail, obviously. So it's not gambling. It's just that you should know your options well. If you know that, okay, I'm not ready. I don't have that much knowledge to invest in stocks. Let's start with something else. And once I'm able to gather that much knowledge, I can invest in stocks as well. So it's all about that perception. It's not gambling at all. It's about knowing what you know and what you're good at. Now let's talk about the options that we have in India. Okay, first of all, we'll talk about the PPF, that is the Public Provident Fund. Public Provident Fund is a government-based scheme, a financial instrument wherein you can invest and you can expect a return of around 7.5 to 8%, which is a decent interest, I'm telling you. Because first of all, it's a government-based security and it's providing you competitive interest, which is a good job. Secondly, it's tax-free. And there are very, very rare instruments in India that are actually tax-free. So that's a big plus why to consider that. Third thing, and really, really important, is once you're done investing for 3 years in PPF, you can actually avail a loan against your balance, which is tremendous. I mean, you can require it. I mean, you can need it at any point in time. So it's actually a big plus again. So PPF, definitely a big yes. Second, we have a National Savings Certificate. National Savings Certificate, or NSC, is also one of the government-based instrument wherein you can actually invest and expect an interest of around 8.25%, which is obviously a very good interest to consider. Now, the reason why I won't recommend it over PPF is because it is not tax-free, so you have to give income tax on the interest that you are getting. So that interest is obviously taxable. But yeah, because it's a government-based scheme, it's an instrument, you can avail a rebate of up to 1.5 lakhs on the income tax as well, which again is a big plus. Number three, we have KTDFC deposits. What is KTDFC? KTDFC basically is an organization which is backed by the Kerala government. Backed by the Kerala government, which means it's backed by a state government, and that's what makes it very safe. And you don't really have to worry about getting the interest on time, and you can expect an interest of around 8 to 8.5% here as well, which is phenomenal. I mean, which is just phenomenal. It is, right? So getting an interest of 8.25% is a good job again. So yeah, you can consider that as well. But obviously the interest here is also taxable. You'll need to take that into consideration as well. Moving on, mutual funds. Now, mutual funds is something I recommend to everybody, be it a student, be it a complete beginner, be it somebody who has experience into investing, anybody. Mutual funds are something you should definitely invest into. Reason: while all other investments that we have talked about work on the concept of principal and interest, mutual funds work on the concept of compounding. What is the difference? I'll tell you. Suppose you have 100 rupees and you invest in any of the schemes that we talked about, be it NSC, be it PPF, be it the KTDFC deposits. And assuming that you're getting an interest of 8%, you know that 100 rupees is what I invest, and at the end of the year, I'll get 108, 8 being the interest amount. That is what is fixed in these investments. Now, when I talk about mutual funds, the scope is huge. Why? I'll tell you. Because mutual fund works on the basis of compounding. Compounding means what? Suppose I invest in a mutual fund which has around 8 to 10 organizations in that consolidated fund. I invest 100 rupees, and on that particular day, the fund value increased by 1%. Then the value of my investment would also increase by 1%, which is the net asset value. Now, if it increases by 1%, if I've invested 100 rupees today, tomorrow it would be 101 rupees. The next day, after this 101, my principal amount won't be considered as 100, it would be considered as 101, which means that now the additional interest or the increase in value I'll be getting would not be on 100 but on 101, which means basis market changes, the value of your investment in mutual funds would continuously keep on changing. And because it's a consolidated fund, there's less chances of losing your money and more chances of actually increasing it at a very, very high pace. That is the reason I would recommend mutual fund to everybody. If you think you're an aggressive investor, you can take higher risk, invest in equity mutual funds. If you think you don't have that much of scope to take risk, you're not that aggressive, you can switch to debt funds. Debt equity funds won't be that risky, and they'll provide you an interest of around 9 to 11% very easily. So definitely these are all options that we can consider. And if I recommend personally, if somebody has a budget of 1,000 rupees a month, I would recommend him to invest 500 in mutual funds and 500 in PPF to make it a better portfolio and to ensure that the risk is actually covered pretty well. So that's how I would suggest somebody to. But obviously this is my personal recommendation. You can have your own choice and you can invest accordingly. So it's time we actually become aware of what options do we have financially and start creating wealth, because creating wealth in the longer run would actually make you successful, not at all the other way. Okay, I hope you like the video. If you do, please ensure you leave a like and subscribe. Thanks a lot.